Hello, and welcome to this lecture overview of the closing process. Now, when we talk about the closing process, what we are talking about is moving the balances from our temporary accounts into our permanent accounts, which is retained earnings, okay? So let's start by distinguishing between temporary accounts and permanent accounts. Temporary accounts are simply our income statement accounts, that's revenue and expenses, plus any dividend or withdrawal accounts. Now, the reason that we call these temporary accounts is because we zero them out at the end of each accounting period. Okay, for example, the company prepares, let's say they prepare an income statement for the year. At the end of that year, that income statement or that net income is going to roll into retained earnings so that they can start the next year with a zero balance in income, and they can start reporting income again for the next year. Okay, so temporary accounts are revenues, expenses, and dividends or withdrawals. All right, permanent accounts, on the other hand, permanent accounts are basically our balance sheet accounts. These are our asset, liability, and equity accounts. We never zero these out. These essentially accumulate from the inception of a company, that is from when a company starts to when they go out of business, basically forever. Okay, these accounts never zero out. So let's talk about the closing process, okay? In the closing process, we are going to transfer revenues and expenses to retained earnings. That effectively transfers whatever net income or net loss we sustained during the period into the retained earnings account, okay? We are also going to clear out the dividends or withdrawal accounts and move that into retained earnings as well, okay? So let's talk about this account called the income summary. The income summary is an account that's commonly used during the closing process. I always tell students to think of the income summary account kind of like a holding tank, okay? It is a temporary account. We only use it during the closing process. You will never see the income summary account on you'll never see it on a trial balance. You'll never see it on a financial statement. It is only used during the closing process, and it's just a little temporary holding tank that we use for revenues and expenses. You're going to see what I mean in just a moment, okay? This income summary account is where we close revenues, it's where we close expenses, and then we move that income summary account into retained earnings. And I'll show you step by step how we do that, okay? The closing process is normally shown as 4 steps, okay? Once in a while, you'll see a textbook that may combine a couple of these steps and may turn it into like a 2-step or a 3-step process, but essentially, you're going to perform all 4 of these steps. You're going to close revenue, you're going to close expenses, you are going to move those balances, okay, into retained earnings, and you are also going to adjust retained earnings for any dividends or withdrawals made during the period, okay? So let's start with the first one, revenue, okay? Now, let's remember that for revenue carries a credit balance, okay? So and this is just an example, of course, here, but so assuming that revenue had a credit balance of $172,000, in this case, this company's got 2 different revenue accounts, some companies do, and they've got another revenue account that had a $3,000 credit balance, because again, a credit balance is normal for a revenue account, okay? When we are closing accounts, I always say that you have to think of it this way, okay? What would it take to get rid of a credit balance of $172,000? We want to zero it out. What would it take to zero that out? Well, it would take the opposite, okay? If we have a $172,000 credit balance and we want to zero that out, we're going to have to post a debit of $172,000. Same thing over here to this account. We've got a $3,000 credit. We want to zero that out. All right, so we're going to zero that out by posting a debit of $3,000 because that will cancel out and give this account a zero balance. Both of these accounts have zero balances. Now you say, well, okay, we're sitting on total debits of $175,000. Where is the credit going to go? The credit is going to go to the income summary account. Okay, this is the little holding tank account that we use just for the closing process. Okay. So the credit goes to the income summary account. All right, we've completed step 1. All right, now it's time to move to step 2. Now we are going to close expenses. Okay, now you're going to recall expenses carry a normal debit balance. Okay, so here we see an example of a whole bunch of expense accounts and their respective balances. Okay. Well, if something is carrying a debit balance and you want to get rid of it, you want to zero it out. How do you do that? You do just the opposite. You post a credit to the account for that amount. So we're going to go through for each of these expense accounts and we're going to credit them for the exact amount of the debit balance. When we do that, it zeroes out the account, and these accounts have a net zero balance, okay? So if we're posting all of these credits to expense accounts, as you see over here in this entry, tons and tons of things are going to expense accounts, we need a big debit entry to offset it. The debit is going to go to the income summary account, okay? Remember, the income summary account is our little holding tank, okay? So it's already holding our revenues of $175,000 over here in the credit column. Now it's going to hold our expenses over here in the debit column, okay? This $135,058 goes right here. Now, what we can do is we can say, well, what is the net balance in this income summary account? Okay, well, it's the difference between the credits and the debits, okay? In this case, it's $39,942. Now, what that is effectively is net income, okay? It's the difference between the revenues and expenses. Okay, so now we're sitting here with this temporary income summary account holding a balance of $39,942. Income summary is a temporary account. We've got to close it. Here we come to step 3. Okay, so the income summary was sitting here with a credit balance of $39,942. We need to get rid of that. How do we get rid of it? We do the exact opposite to it. It has a credit balance. We're going to debit the account for $39,942. The corresponding credit is going to go to retained earnings. Remember, retained earnings is an equity account. Because it's an equity account, it carries a credit balance. So when we post a credit to retained earnings, we are increasing retained earnings. And what we have done here, folks, is we have essentially moved net income out of those temporary accounts. We have moved it into retained earnings, which is a permanent account. Last step, step 4. We are going to close the dividends or withdrawals account, okay? Now, I keep saying dividends or withdrawals, and the reason that I do that is it's going to depend a little bit on the textbook that you're using. If you're assuming that the company is a corporation, we call it dividends, okay? It's basically distributions to the owners. If we are assuming that the company is a sole proprietorship, like a single person owns the company, then we typically call it withdrawals. But it's the same thing. It's distributions out of retained earnings that are made to the owners of the company. Again, if it's a corporation, we'll call it dividends. If it's a small company, singularly owned company, we call it withdrawals. Okay, in this particular example, they're using dividends. Okay, but it's the same principle. All right. So the dividends, now remember, dividends carry a debit balance, okay, quite similar to expenses, okay? It's not an expense, but it carries a debit balance, just like expenses. Okay, so dividends is sitting here with a $14,000 credit balance, okay? So if we want, a debit balance, okay? Dividends is sitting here with a $14,000 debit balance. We want to make that go away. What do we need to do? We need to post a $14,000 credit. That will cancel out the $14,000 debit and give dividends a zero balance. Okay? Where does the corresponding debit go? The corresponding debit is going to go to retained earnings. Now, remember, retained earnings carries a credit balance. So when we post a debit to retained earnings, we are reducing retained earnings. And if we think about what dividends and withdrawals are, that makes sense. When we pay dividends to our shareholders, or when an owner takes a withdrawal from the business, it is reducing the amount of earnings that are being retained within the business. It's reducing retained earnings. Okay, so this is it. This is the four-step process. We closed revenue to the income summary. We closed expenses to the income summary. We closed the income summary to retained earnings, and then we closed dividends to retained earnings. When we do that, we have zeroed out all of the temporary accounts. And what you'll notice is a post-closing trial balance should effectively look like a balance sheet. Okay? A post-closing trial balance is not going to have any temporary accounts. It's not going to have revenue, it's not going to have expenses, and it's not going to have dividends. It is essentially only going to have assets, liabilities, and equity. Again, looks a lot like a balance sheet. If you prepare your post-closing trial balance and you have revenue and expense accounts on there, you've done something incorrectly. All right, you'll have to go back. But this is the basic procedure for closing out accounts at the end of an accounting period.